Welcome to another weekly market insight. I'm joined today by Chris. John is still down in Florida. Today we are going to go, or what we always say is that we try to get past the noise and get to the signal. And we're going to go over technicals. Now I often joke, because it's really like reading tea leaves, but Chris actually has more confidence in it. He considers it astrology for adults. What is my horoscope today, do you know?
We make fun of it, but we do spend a lot of time doing it.
Yes.
And we know that factor investing does work.
Yes.
And a lot of times, reading the charts and technicals just get you to a certain factor in the market.
And it gets back to, it really gives you a signal through the noise. Now the signal is not 100%.
Right.
So why don't we just jump into it and look at the performance from the different asset classes that we're going to review on a technical analysis. And if we were looking on Friday, and this is to yesterday, we could see that crude oil was actually rebounding quickly, followed by the commodity index, Russell 2000, the NASDAQ, and we can keep going on. But if we look at a 7-day window, we can see that the Russell 2000 is positive, but man, the NASDAQ composites up as well as gold and the core bond. And what we are trying to say is that there's a quality bias to these types of asset classes. Technology is kind of unique, and we'll get into that. But if we look at it, there seems to be a movement of or a flight to quality within the market because there's a lot of noise out there and there's a lot of concern. And we've been into the S&P 500, so off to the left here would be just the chart of how it's moving, and then we have a point and figure chart. And the point and figure chart really gives us a good way to look at where support levels are by removing a lot of the noise that's here. So we can see that the July bottom was at 42.30 on the S&P 500, and if we went back to June, 41.60. Right. And what's happening now up here? That's a double top. Do you want to give us a quick recap on a double top?
Just prices are going back to a price they've seen relatively recently, and there was a slight breakout above that.
Right.
That's going to get some short-term technical traders to come in and buy that breakout.
Right.
And again, this is the S&P 500. This is large cap, 500 largest companies.
And we've been seeing that the S&P 500, we're going to look at other charts, but I'm kind of getting ahead. It's one of the few that's having a breakout. So it's making new all-time highs where other indexes are not. And that's one of the reasons that we have been moving portfolios, especially in the qualified area where taxes don't really matter on trades, towards those large cap stocks. I think Ted said it best in the investment committee on we're kind of clustering around these large cap stocks because that's where the quality is right now in the market.
And when there's not necessarily a large trend in the market, we like to stay in the S&P 500, which is our benchmark for large cap stocks.
Absolutely. So then another way to think about this is we're going to take the Russell 2000 and divide it by the NASDAQ 100, or those Qs. So whenever the purple line is moving up, that's whenever the Russell 2000 is outperforming the NASDAQ 100, and whenever it's moving down, that's the NASDAQ 100 outperforming the Russell. So that's given us that comparison, but we're going to compare it to something else, which is the interest rate on the 10-year Treasury, which is over here on this axis. So we're starting out below 1%. We move up to a little bit right around 1.75, and now we're back near the 1.2. And the trend that we notice here is when the interest rate was moving up, that's when the Russell 2000, those small cap stocks, were outperforming. As the interest rates decreased, we could see that the NASDAQ came back in. And now there are reasons, you want to get into some of the economic reasons?
The equity markets often get their cue from the bond market. And as you see rates start rising, bond investors are really pricing in a strong economy, which would be really, really good for small cap, the Russell 2000. So as you see rates coming up, expecting some higher inflation, you see improvement on the small caps. And then the exact opposite's going on the way down, that flight to quality that you spoke about.
Right. So then let's look at so we talked about some U.S. domestic where we moved from small cap up to large cap with an emphasis on large cap growth, but we also have an underweighting to international. Now, one of the things that we've talked about early on in the year was the value rotation, but we've since seen that growth come back.
Right.
And when we're looking at international, we look at demographics, we look at a lot of other things besides just the value growth aspect, and we've been underweight that. But here's another reason why you want to be cautious about entering international. I think wholesalers have been telling us we want to be an international for about the last 10 years because of price to earnings. I think they're eventually going to be right. It's just taking a long time to be right. And in the meantime, you're missing out a lot of performance.
They keep saying it looks cheap because of price to earnings, but those price to earnings are low because there's low growth there.
Right. It may be cheap for a good reason.
Right.
So what we're going to look at here is the exposure breakdown of the international IFA, which is the broad index of international developed companies, compared to the S&P 500 based on this sector. So the first thing is cash or derivatives. And both of these are ETFs. They're going to be very small in the amount of cash they hold. Then we can get to communications. And we can see that the IFA holds 4.68%, while the U.S. Holds 11.26% in its large cap. So that's just an idea of how to compare this, because really, where does it matter? Well, if we go to the biggest holding in the international index, we can see its financials at 16.74%, while the U.S. is 11.12%. So there's a significant overweight relative to the U.S. markets towards financials. Those are typically value-oriented companies. On the other side, if we look at information technology, the S&P 500 has a almost 30% weighting, while the IFA has less than 10%. So that's a big growth. I would say a lot of the international developed companies are really economies that are not developing at a quick pace, so they don't have a lot of the growth stories. They have more legacy type companies, nothing really developing. They don't have Square and some of the other companies that are getting put in here.
In the fintech space, they're more the legacy banks. And you mentioned being underweight. The global portfolio is roughly 60-40 U.S. versus international, and our benchmark is about 35% international. Portfolios are down to about 15 in the qualified space, and in the taxable space, we've really removed almost all exposure.
So we're underweight, but we still have a position. And what we did, since we're going to get exposure to international, and we know that the international index has this value biased relative to what we want to hold, we just buy a growth international fund. So that's one way. If you need to get international exposure, just allocate towards some growth funds. Also, one of the reasons to have international exposure is diversification. Now, there's a number for diversification, which is a correlation coefficient. Fancy number, but the lower the number, the more diversified it is. The more it's going to zag when everything is zigging. Now, we have a belief that if zigging is working, we want more zigging. We don't want to add zagging if zagging isn't working. And if all of a sudden zagging's working, we want to move to zagging. So we're not really into building these portfolios for diversification diversification's sake. We do want to move money to where it's working in the market. But if you were looking for a diversifier, maybe look at the small cap international. So this example, it's hard to see, but the red, it would be the IFA to the S&P 500 and its correlation. We can see it's at 0.62. While the small cap international is actually at 0.24. So that means that there's lower correlation. And if you're holding international because of diversification reasons only, well, you want that lower score. So that's another way to get some diversification, because if you own Pfizer versus AstraZeneca, you really don't have much diversification there, because they're basically global companies that are really going to move in tandem. So look down the market cap in international if you're looking for international exposure. Once again, we are underweight, but we do hold an international growth fund as well as a small cap international fund in that international bucket. Next thing is China and what's going on there. You want to give us like a quick skinny on what's happening?
So it's become a tough market the last couple months. It makes up about 30%, China does, of the emerging market benchmarks and index. And really, there's some good companies there that look innovative, but as soon as they start looking too good, the Communist Party is saying, no, we take a look at this. And so when you're forecasting out cash flows, you really have a hard time determining if these are yours as a shareholder or not. Yeah. So the real question you get down to is China investable? Because every other week they're cracking down on a new sector, and then the next day they have to clarify, and it becomes really tough to know.
It does, and it's things that it could be in education platforms. Recently, Tencent was looking at video games, and China has a policy where they're trying to reduce the amount of time their children are spending on video games. So once again, if the Communist Party comes in and says, hey, it's a great company model, hey, those are great cash flows in the future, we either are going to take them or we're going to shut you down because we don't think that this is a good thing for the market. Well, that is a problem because we're buying stocks because of future cash flows if they're not there. And the reason it's showing up in the emerging market index, as you mentioned, is it's 33% of the emerging market index. So that's certainly problematic, which then gets us to some of the other things, which is the Belt and Road Initiative, which really kind of lines up with what's going on in Afghanistan. We try not to get into politics, but this is geopolitics, and it really does have a major impact on the market. So China has been working on the ability to create this one belt, one road. And I'm going to get really dorky here. Chris is probably going to fall asleep and make fun of me, and that's okay. But what you have is historically this red line represents the Silk Road. And up until the West became really a maritime superpower, where England would start to go through and they built the Suez Canal, they hold Gibraltar, and they'd get over here and they'd even have Sri Lanka, where you have the South China Sea, where you had a lot of choke points where naval power, if you just had these points, you basically could control trade. The thing is you could always go over the Russian steppes into Europe and really be able to drop into to India, a big market, as well as Northern Africa historically as a big market, and getting in through Constantinople, Istanbul, depending on the time period. There's a lot of things that are going here on global trade. So China, knowing that it's blocked off on the South China Sea, has been trying to make inroads into reopening that Silk Road. And with the power vacuum in Afghanistan, we're starting to see them approach the Taliban as the U.S. leaves. Why? Because there's this walk-on corridor, I know I didn't pronounce it correctly, which is about the only way you can get through the mountain pass and into what is known as the world island on Heartland theory and be able to get that trade. There's also another pass here that would drop down in India. So Afghanistan for the Silk Road is one of those choke points that you have. Now, Afghanistan is also called the graveyard of empires, going all the way back down to Alexander the Great. Trying to control this basically runs your treasury out. So I don't know how well they would be able to offset some of the problems, because the Belt and Road Initiative should have been used for the last 1,000 years. There's actually what's known as the Great Game. There's a book by Hopkirk, if you're interested in the history of reading about how the United Kingdom and Russia would fight in Afghanistan and on these Silk Roads. A recent book, Peter Frankopan's Silk Roads, and if you're a literature buff, read Kim by Kipling. All of those will really describe what's happening here, and I think it's a really important thing to understand for the geopolitics and trade routes that we're dealing with now. It explains a lot of things, and Chris...
I don't even know what to ask you.
Chris is always looking at me oddly whenever I talk about it.
Only 2 slides. That's good.
So then if we're looking at fixed income, commodities, and real estate, fixed income, whenever we look on technicals, it's not horrible, it's not bad, but you're really not getting paid to be there. And then if we look at commodities, which have done well over the year, it seems like there's a lot of wind coming out of those sales. Oil, which makes up a large percentage of the commodity index, has been struggling. The last couple of days it's been moving up, but if we look at a technical indicator, it's not doing well. Really odd, gold, through this time period where inflation, whenever we're looking back over the last 12 months, hasn't really moved. It's been struggling whenever we look at the technicals. But real estate, which is an alternative, especially if you're looking for fixed income but you're looking for inflation protection, right, this real estate can help provide some of that income while also giving some of the inflation protection that the commodities are not doing. That's a place to be, and when we're looking at it, it is technically strong. There are certainly fundamental reasons to be cautious with it, with the move to e-commerce, retail space, the move to work from anywhere as a program within much of corporate America, putting some demand issues and slowdown in demand for the office retail space, but it still continues to move up. Which gets us to our last thing, is those are all going to be affected by the FOMC. They're meeting virtually at Jackson Hole, where if I was in this meeting and invited to the meeting, I would not be doing virtual, because man, it is beautiful there. But what do you think is going to come out of this meeting?
Yeah, so we talked about tapering about a month ago or so, and really we have to start with, what do we know? Well, the Fed so far said they are going to taper their asset purchases when they reach substantial further progress. They put no numbers on that. We have no idea what that means to them. Substantial further progress towards their goal of maximum employment looks to us like they should have met that. And so they should begin tapering. And the market's looking for that. Right now it's about 120 billion, 80 billion in treasuries, 40 billion in mortgage-backed securities. The only other thing we know is they said they are going to reduce them at the same proportion, which is something we said a couple months ago. We thought it would make sense to stop the mortgage-backed securities. That market looks like it's functioning well. We don't think it's needed there. They actually said the opposite. They're going to do it proportional. So that's all we know that they've told us so far.
And when we look at the dot plots and some of the other things that we've covered, which is the projections of what their interest rate will be, 24 months, 12 months, just different time frames, it's always that they're increasing it in the future. I don't think I've ever seen a dot plot where it's actually a decrease. And then when we get there, it's never as high as what they were projecting. So the Federal Reserve they want to keep the market flush with cash. It's much easier to deal with. You see markets move up, and they'll just say, well, let's raise interest rates later. So it's probably going to be something similar coming out of this is, yes, we're going to raise rates. Yes, it'll be this. And then whenever you get there, it's never really all the way to the level that they were saying. So they're far more cautious.
That's really what we're expecting, a very slow taper, that they start reducing these purchases, whatever it be, 20 billion per quarter, and then keep kicking it down. What would be negative for the market is if there's a PCE inflation number on Friday as well, same day as the meeting. If that number came in high and scared them and they said, you know, we really are going to start tapering over 6 months, that would be a concern to the market and you'd see a pullback.
But we think that's unlikely. Even if there was a high number, that they would actually start to be aggressively, because they have not, while we've seen high numbers for quite some time.
They still have Delta that they're going to be saying is hurting employment. So we expect it to be, you know, in that 6 to 12 month range of slowing down their purchases.
Right. A less accommodative monetary stance is still an accommodative monetary stance.
And there's also the chance that they don't even announce at this meeting. It could be they could kick it down in the next meeting or even a month later.
So then let's move on. Typically this is where we went into the technicals, but that's pretty much what we covered today. We can see it in our chart that you want to be in U.S. large cap growth. The S&P 500 is near the top, so you're moving up market cap. International is kind of scattered through here, but emerging markets is the worst performer. We have been lowering our exposure there and moving into those large cap growth in the S&P 500. U.S. real estate is also above the S&P 500. So if you're looking for yield, and you want something that can offset some inflation, possibly, historically it's done well, that may be a spot that you want to emphasize. Lower some of your fixed income exposure, move that exposure to real estate. Don't worry about the commodities so much in your portfolio. Anything else that we want to cover?
No, I think we covered it all.
All right, well, thank you for listening, and if you haven't subscribed, make sure you click down in the corner and subscribe, and if you have any questions, feel free to reach out to our lead advisors on the number on the screen, and Chris and I are also happy to take any questions, comments, or calls. Thank you.